Sometime last year, we did a webinar, a year-end webinar for the year 2020, only because 2020 was such a challenging and unusual year for everyone across the globe. We decided that it was only befitting to do one, and it was very well received. And we are back on popular demand, doing another year-end webinar this year for 2021, the year that it was, as well as our outlook for the next year to come, inshallah. And the agenda for today is we will begin with Kareem Al-Gabri, our portfolio manager for Sharia Portfolio USA. Kareem will be unpacking the last year, 2021, and he will also be kind of comparing the outlook that we shared last year when we did the year-end webinar and see how many of those points did come through. We will continue our presentation with Irfan Chaudhry. Irfan Chaudhry is a subject matter specialist and our affiliate from SP Funds. Irfan also looks over the SP Funds for us. We'll be concluding today's webinar with our Vice President for Sharia Portfolio USA, Ali Rada Walji. Ali will be sharing his outlook for the year to come, 2022 and beyond. And we will be ending our webinar. We'll be saving some time towards the end for the Q&A session. So please remember to submit your questions in the question box that you see on the screen, not in the chat box, but in the question box. And we will make sure we'll address all the questions. We're going to try our best to do that towards the end, inshallah. So without wasting much time, I'm going to hand over the control to Kareem so he can start presenting. Kareem, it's all yours.
Assalamu alaikum, everyone. Thank you for you, Sister Shafaq, and thank you for everyone who's attending our webinar. So as 2021 winds down, inshallah, we are going to discuss and cover what's happened in 2021 and what kind of lessons, inshallah, that our investors and us also can take away from this past year. There is a lot of lessons, but I'm going to concentrate on one specific lesson, and I think it's going to benefit us a lot, inshallah. As Sister Shafaq mentioned, last year we mentioned some of the points, and as you see it on the slide now, and alhamdulillah, almost 90 to 95% from what we mentioned last year, we already was correct. Yeah, around 95%. We were correct with all the points that we discussed and covered last year. So for example, we covered about the stimulus, of course, about the COVID, the economic recovery, as you see, the corporate earning, and that they are going to beat most of the expectation because of the easing of the lockdown and the opening of the economy, about the cash on the sideline, the strong demand, inflation, rising interest rates. So we covered all these points, and as you see, these points are the main driver for the market in 2021. And alhamdulillah, again, we were correct almost by 95% for most of these points. And as you see, there is some points was negative on the market. For example, inflation was negative on the market, raising interest rate is negative on the market. With the Delta variant or the new COVID now, it's negative on the market. The tapering is negative on the market. All these negative points that it was in the news in 2021. Okay, the slides, go ahead, next slide.
Oh, you don't want to take the control?
It's not, I don't have control, yeah. I'm trying. Yeah, as you see, with all the negative news in the market's still going up and up and up. And this is weird. The only thing that mainly that drive the market to continue to continue to go up, and as you see, we are still in the bull market, and this is it has been for a while in the bull market. The low cash yield and the very low bond yield or the interest rate. These are the two main drivers for the market to continue up and to continue in the bull market, as I mentioned. Even though, as you see, we are at the peak of the market and the market valuation is pretty expensive, but still we are continuing to go up and up. And only one point I want to share it that the market, for the first time this year, the market pulled back by 5% plus, or more than 5%. The market drops. It was in the end of the last quarter in September, and this is also another point. It was weird. Again, like the main two drivers for the market was the interest rate was very low and the low cash yield that's helped the market to be in the bull cycle or to continue going up. Next slide. So as we mentioned in the previous two slides about the market, so what lessons can investors take away from this past year? It is not the lessons for the investors only, and for us as a portfolio manager, as a financial advisor, I think it is a very important lesson, and you will know why I'm talking and I'm mentioning this lesson especially and why it's very important. Yeah, this is the lesson. Yeah, it is only 3 words, the TINA theory, but still it is very, very important, and you will know why it is very important. What is TINA theory and why we are concentrating and why we want to mention it in our review for like 2021. So TINA theory, as you mentioned, here's the definition of TINA. TINA is there is no alternatives, and I will be honest with you. Really, there is no any alternatives. Let's say with the low cash yield. Low cash yield is still promoting and supporting the TINA theory. Let's say that you have cash and you are going to deposit it in a bank. How much interest you are going to take on this cash? Nothing at all. So this is supporting the investing in the stock market. There is no alternative. If we went to the low bonds, if you want to invest in the bonds, how much is the yield on the bond? Nothing at all compared with the return on the market. So this is also supporting that there is no any alternatives except the stock market. If we are going to talk about inflation, what kind of investment going to offset the inflation or hedge against inflation? Again, you cannot find anything else except the stock market. So this is also supporting the TINA theory. If we went on and on and on, you will find everything is supporting the TINA theory. Now I'm talking especially about like the 2021, and this is a short time frame. Let's say if I'm going to talk about the stock market in a longer time frame. Let's talk in the past 20 years or like 25 years. How many times the stock market crashed? It's 3 times, in 2000, 2007 or 8, and in the COVID crash. Each one of these crashes, the market drops by more than 35%. In 2000, the market drops by almost 45 or 50%. In 2007 or 8, the market drops also by another 45%. And the COVID, the market drops by 36 or 37%. But even though the market is still going up, hitting new highs, and we're still in the bull market. And this is a confirmation about the idea or the theory that we have been talking about, which is the TINA theory. There is no alternative except investing in the stock market. Now, inshallah, we are going to talk about the passive and active. And so let's dig deeper in what happened exactly in the market in 2021. As we mentioned that we were in the bull market in 2021 and for a while, and the market is continuing growing and going up and up and up. But I have one question for this. Is the whole market was performing well? Is the whole market was doing well? The answer is no. And this is weird. Yeah, the market is up, but everything has to be good. No, not everything. And here comes the passive versus the active. So this year in 2021, passive was outperforming the active investment. Passive, what is the meaning of passive? I will make it easy and simplify for the people. Passive it is more like towards the conservative style, or we are mimicking a benchmark, let's say like the S&P 500. So we are not taking a lot of risk or high risk, and we are investing in value stocks. So the passive, was outperforming the active investment in 2021. What about the active investment? Active investment is the aggressive style with high risk. And subhanAllah, this is totally different than 2020. 2020, last year, the active was outperforming the passive. And as you see on this chart, this is like the difference between passive and active. And you will see that it's a cycle. It is cyclical. And both of them, they shine, but in a different stages. And I want to concentrate about the active to make it easy also about the active and the aggressive style. The most famous example that we can mention today is ARK Investment. ARK Investment, it is the famous fund active manager, and Kathy Wood, she's the fund manager for this active management, ARK Investment. Their performance year to date is down by 25%. Compared with the S&P 500, S&P 500 as year to date now, it's up almost by 20 or 21%. So see how the difference between the passive, which is the S&P 500, and the active, which is the ARK Investment. And it's not only the ARK Investment. If you check any growth active management funds, you will find that their return this year wasn't good at all. But again, I want to concentrate about only one point, that it is cyclical, which means that if you see the chart, this chart, you will find each 10 years, it is like the time for active and the passive. Here is the blue line, which is the active managed fund or return, and on the green line, it is the passively managed fund. So by this, and after discussing the passive and active, let's discuss and see how our, as a Sharia portfolio, how we structure our portfolio. So when we structure our portfolio, the most important thing we put it in our consideration is to preserve the capital for our investors. This is the most important thing. So we pick the core satellite approach, which is the combines between the best of the both or the two worlds, which is the active approach and the index approach, as you see on the chart. The index approach, this is the passive investment. So we combining both of them in our models. And the reason for this is to balance and to lower our risk. And alhamdulillah, with our models, we are outperforming our target return on the long investment to long term. We are outperforming, alhamdulillah, this is by the grace of Allah, that we are outperforming our target returns on the long term. Our target returns on the long term, average per year return for the aggressive, the range is between 9 to 12%. For the moderate, it's 7 to 9%. And for the conservative, it's 4 to 6%. And again, we are outperforming this by the grace of Allah, and by combining the both approaches, the active approach and the passive or the index approach. With that, I will turn it to Sister Shafa, and thank you again for attending our webinar. You are on mute, Sister Shafa. You're still on mute.
Sorry, that was a bit of a struggle. I don't know why it wasn't unmuting me. Thank you so much, Brother Kareem. First of all, thank you for clarifying the mystery about Tina. So we're all relieved. It means there is no alternative. And I hope everybody found what Kareem presented useful, inshallah. Now we will hand it over to our subject matter expert, Irfan Chaudhry, since he overlooks the SP funds, aka passive investing. So he'll pick up the thread from where Kareem left about listing the differences between active and passive investing, and he'll also share some information about SP funds. Brother Irfan, I have already shared the control with you if you would want to take it, or I'll be happy to do the slides.
I think you better keep the slides.
Okay. All right, I will do that. Here you go.
Okay, thank you. And just a moment. All right, so thank you very much, Brother Kareem, and Assalamu alaikum, everyone. And thank you very much, Sister Shafak, that giving a very nice introduction here and summarizing what Kareem said. I just wanted to kind of present my face here because just to put that the ETFs to connect with the person. I am the go-to person for the ETFs if someone has a question. So I'll just try to keep it brief here and try to give it a baton to Ali next. I will say a few words in continuation of what Kareem said. Our passive or ETFs are the passive, but they are an integral part of our portfolio management system. All our portfolios, the core consists of the ETFs. ETFs we constructed with a lot of effort. We did were preferred partners for S&P 500 and Dow Jones indices. And we worked very diligently with them to construct these. We backtested them over different time zones and over a longer period of time to judge the risk and return profile of these. So their performance actually goes with the performance of the actively managed Sharia portfolios as well. This year, as the previous year, last year, 2020 and 2021, both the years were the great years for our funds. They were able to preserve the capital in two different instances. One in 2020, when the market went down 36%. Our ETF SPUS was only down 30% during that time. And up capture means like when the market is going up, generally the funds which are defensive, they do not outperform the market when market is going up. But in this case, year to date, SPUS is around 34%, around 10 percentage points higher than the broader market. And so is the case with SPRE, which is even higher, is around 35%. AUMs of all assets in all these ETFs grew a lot during this time, during the COVID. Did not affect the COVID times. Uncertainty did not cause an outflow. Investors kept our confidence with them, with ourselves. And now, alhamdulillah, SPUS has grown to almost $130 million, and the combined three ETFs is now around $200 million. SP Funds is around $200 million. That's a landmark for us. And inshallah, we keep growing next year. As far as the outlook, I think we have put together quite a few initiatives for next year. One is the institutional adoption. Institutions right now, they are adopting these ETFs for their retirement products, and they're also getting these ETFs onto their financial advisors platforms. We are lucky to have these in-house ETFs, and we are the home of these ETFs. Like organizations like Manulife, Franklin Templeton, Stanhope Capital, Berhard Capital. These are the global firms. Some of them are North American, but a lot of them are global firms. All of those firms now already have these ETFs on their platforms, are using these ETFs in their retirement products. So inshallah, it will keep going. And this year, the floodgates has broken open. And I think we are going to do very well next year as well in terms of performance, because as the quality, we expect the quality to outperform as a factor. So Sharia investing itself that creates that bias in the favor of quality. I think that's roughly what I wanted to say in regards to the ETS, a very brief summary, and I will hand it back to Sister Shaf. And if any questions later on, I'll be happy to answer them.
Thank you so much, Brother Irfan, and thank you so much for, sorry, my slides are a little bit getting ahead of me. Thank you so much for tying the thread where Kareem left and, highlighting the fact that Alhamdulillah, Sharia portfolio, we have the best of both worlds. We have the active and the passive, and it's in-house, and we're able to balance out the investment accounts for our clients. So with that, I'm going to give over the control to Ali. Would you like to take the control, or do you want it to continue the way?
Actually, if you can continue it, that should be fine. I'll just signal when we need to turn it to the next, if we need to do it that way.
Okay, thank you. So I'd like to introduce our next presenter, Ali Radawalji, the VP of Sharia Portfolio USA. And of course, he's last in this webinar, but he has the toughest job, which is to predict future. Of course, no one can predict future, but we definitely can analyze based on the data that we have and the research that we do, and attempt to share our outlook for the next year and beyond, which is what Ali Radawalji will be doing. And it's all yours, Ali.
Thank you, Shafaq, for that introduction, and appreciate the insights that we were able to benefit from Kareem, giving us idea on what was happening in 2021 for their fund on the fund side. And inshallah, we'll try and talk a little bit about what we see going forward. Of course, as Shafaq mentioned, we're not fortune tellers, but we do our best to be able to give you the analysis and information based on what we are able to see from the trends out there. So on this slide here, you'll notice that there are different analysts from companies, of the big name firms, and they have all provided different target prices for the S&P 500. Of course, this is just one of the major indices that is commonly seen by analysts to benchmark against. Industry professionals use this as well. So from this chart here, from the data that they are showing us, of course, there are folks who are on the higher side and there are those who are lower side. So the average is seen as around 4,800. We are currently around 46 something, 47 actually, as of today's close. So, it is not far-fetched to see us hitting the 5,000 level potentially next year. But according to this, we can easily see that people are calling for a 7 to 15% gains in the market, and we'll see what the future holds. So just wanted to share that out there. On the next slide here, what I do want to highlight is something that I found to be helpful in explaining also some of the trends in the market. Generally, in the Q4 of each given year, you will find that a lot of fund managers, portfolio managers out there try and do something called tax loss harvesting, which is the process of selling some of your losing names in the portfolio and then coming back around a month or so later and buying those same names again. And this is often done in a way so that it can help to offset any capital gains in the portfolio, especially for taxable accounts, and helping you to kind of still benefit from those same holdings the following year. You have to wait 30 days to avoid something called a wash sale, but that's something that often happens. And to put losing stocks into perspective, we have found that they generally produce the equivalent of almost 55% return gain in January. So it can be quite substantial. We try and do some of that in our portfolios as well if we see the right moves for us. But this is something that you want to keep in mind as a trend that does generally happen in Q4. Over here, we are talking a little bit about the impact of money printing. We've all seen that there was a lot of stimulus that was being dished out in the economy to help those who are struggling. Individual families as well as businesses were being offered money, and the Fed had increased their balance sheet through something called quantitative easing. So in this, how does this basically affect inflation, which has been a talk of last few months, almost the whole year. People have been talking about it. Well, a simple thing to keep in mind is if you have, let's look at a hypothetical scenario, you have 1 million as the number of goods. If the money supply in that particular region is $10 million and the average price of any given item is about $10, and now we just go ahead and tweak one of those variables and end up producing more money and putting more money into the system. Now we've doubled the supply of money. Well, that does not always mean that the number of goods goes up, right? If we assume the goods remain the same, then what are we doing to the price? Effectively doubling the price of money. So that is what happens when too much money enters the system. And generally, QE and providing money to the economy, pushing money into the economy is a positive thing in general, because it helps to with certain breakthroughs, scientific breakthroughs, or if they're struggling businesses, to help them kind of stay afloat. But it can be a problem when it gets too when it gets too much, like what we saw in 2008 and some of those crises that were driven that resulted due to too much debt. So that's something that we often we have to keep in mind as well. So let's look at the next slide. Inflation, consumer price index. Everybody can attest to the fact that if you've tried to buy different things during the pandemic, cost of food, cost of appliances, cost of clothing, and even things that we typically may have not noticed in the past, have trended upwards. By and large, one of the largest effects is at the gas pump, right? Most of you who are going out there to fill up the tanker, unless you're driving an electric car, you probably are feeling the pinch every single time. So CPI basically has jumped 6.8% from a year earlier. It's basically at a 39-year high as of November. And a lot of that was caused by, effects of COVID-19. There was a lot of demand that was coming in from people who wanted to buy different things, supply chain issues that we found, things getting stuck at the ports, lack of labor shortages, drivers and things like that, they were not able to find. So obviously all of these things working together created a lot of the issues that we are facing with the cost of goods. But the expectation is that, inshallah, by second half of 2022, when supply and demand issues kind of work themselves out, hopefully the inflation numbers do not remain as elevated as they have been. But we'll see what comes about. So question that everyone has on their mind is, which sectors that you should be considering to invest in, right? What asset is the best hedge against inflation? Everyone's thinking about that. Well, according to some of these research that was done, during periods of inflation, the green, which is equity, often, as you can see, it does best. And Kareem pointed that out earlier. Equities are often going to attract a lot of money because of the fact that they do produce better returns as compared to the fixed income, which is generally the bonds or sukuk, for example, may not yield as higher of a return because, historically speaking, as you can see, the blue section often does not as well. REITs, on the other hand, are areas that generally do quite well. And we are often, we've definitely, alhamdulillah, benefited from the SPRE, for example, within our portfolio. So REITs is an asset class, hard assets, they do well in inflationary times. So this is just something to keep in mind. And we're watching the macro backdrop to see how things are changing and working our best to adjust what we're doing. But one takeaway here is cash is no longer a play. You cannot hide in cash because, as you can see, inflation being such high numbers, you're losing the purchasing power if you're sitting on cash. So, we can always come up with different ideas on where to invest in the market, but cash, we all agree, is generally not the best strategy. So small caps also are seen by analysts as potentially producing bigger returns and outshining. Small and mid cap stocks could outshine. So there is a potential for some of that happening. One thing also that I like to highlight is that, as COVID is shifting to an endemic, and, most people really, might have thought of it as transitory, like the Fed thinking about inflation, but in reality, COVID is not here to go away, just like that. I think people are learning that we have to adapt to it, but it's definitely around. But there is a lot of trends that we're seeing. Digitalization, some of that was accelerated in COVID. You're all attending today's webinar, for example, through Zoom, right? Zoom was something that would have taken maybe 10 years to reach the levels of usage that we are seeing today and even in last year's numbers. But that got accelerated during the whole COVID situation. So we've seen digitalization, AI, 5G trends happening before us, demographic trends with the global aging population will also drive demand for healthcare. So we feel technology, healthcare are some of the areas that could do quite well moving forward. Let's look at the next slide a little bit, because this is one of the topics that I find a lot of people have probably been thinking about or talked to someone who's mentioned something or the other related to cryptocurrencies. We all know that currencies are backed by debt. Globally speaking, the US government has put themselves in a box with all the money printing. It has ballooned too fast, too quickly. That's what you saw in the QE slide that I showed earlier. And the only way that folks can escape from this is to inflate out of debt. And what does that mean? Is to make it valueless through inflation. The more money you print, the more the currency debases. So, in such a situation, crypto assets such as Bitcoin are seen as hard assets, and some are even calling it as being the hardest asset. And why is it seen as a hard asset? Number one, it's very scarce. Over 90% of the total supply that will ever be available of Bitcoin has already been mined as of Monday, this week actually, which means that there's only 10% left to be mined, and it's only going to be 21 million coins available. But in reality, we know that people might lose their coins due to forgetting seed phrases or sending it to the wrong address. And mining companies are also not selling. There's a lot of Bitcoin mining companies out there, and many of them are holding on to their Bitcoin. So this is some of the things we're seeing. Of course, this is a very volatile asset class, but we have been exploring this and especially considering it within some of the aggressive strategies. If you have any questions about this area, please do schedule a call with your advisor to discuss in more detail. But I just thought of mentioning this. A lot of money we are seeing flowing out of assets like gold, for example, coming into this space. With the low supply and high demand, we could see a lot more adoption happening, because we feel that we're at the early stage of adoption. Moving forward, it could serve as a medium of exchange, but we'll see where things go. On the following slide here, we are talking a little bit about 10-year yields, which is often another topic of discussion whenever you open up any of the different channels or read an article on the Wall Street Journal. One thing to keep in mind is that the trend, as you can see, is downward. So we don't necessarily expect that debt is going to yields are going to go up anytime soon to a level that was in the 90s, for example. That just does not seem feasible. And one thing is that people have become accustomed to the easy money policies. If you tapering has been mentioned, and today earlier the Fed did mention in their meeting that they are looking to phase that out. And that was something that was kind of expected and priced in, doubling the taper pace, and also starting to consider rising the interest rates after that, which is probably going to be in the second half of next year. But the reality is that rates are probably going to remain closer to zero, and that is as a result of too much debt. When you have too much debt, the cost of financing that debt becomes too much, and to keep the economy going, you have to maintain low interest rates, so that things are flowing around in the system. Businesses are able to borrow at lower cost and continue doing their operations. But when interest rates go up, which is often seen as a tightening the belts out there, then that can cause a little bit of a tantrum, as we've seen in previous situations. So I don't think the Fed wants to kind of spook the folks as much. And we did see that following the meeting at 2:30, 3 o'clock, the markets were reacting favorably. So it looks like they're not trying to do anything aggressive other than what they have mentioned so far to us. With that, let's go ahead and look at this last slide, which is going to cover the pros and cons of investing in equities, right? One of the pros out there is that there is a lot of cash on the sidelines, right? We did see at one of the figures in the previous presentation, it had mentioned 4.3 trillion in cash. The consumer remains very strong. There's a lot of pent-up demand. People who could not travel or go to restaurants. They've saved in the COVID situation, so they have desire to spend. So there is a lot of cash out there, which I think will flow into certain assets like the equity market. We're still in a bull market. I know it might not look that way for some aspects of the market that are not within the S&P 500, but overall the trend is looking good. When it comes to choosing, right, you are as an investor are thinking, what are the different choices you have? You can either go to stocks, bonds. Bonds, we mentioned, are lower yielding, so may not look as attractive for someone who's looking for a higher return. And so you're basically going to be stuck with either equities or riskier assets like cryptocurrencies, for example. And as Kareem mentioned, there is really no alternative. So staying invested is probably going to be in everyone's best interest who is looking to beat inflation, especially, and not lose the purchasing power of their money. What else is gonna give us the confidence that the market is still strong? Well, corporate earnings. We're seeing that over 70% of companies that have been reporting on their earnings calls are beating earnings as well as their sales estimates. So that is a very positive sign. Well, we don't want to just look at the pros. We want to balance it out with what are the risks out there? What are the things that we need to keep in mind that could derail things, as well? So one of the areas to be mindful of is the valuations. When you look at the total market cap, which is the value of all of the companies within the market, not just the S&P 500, but others as well, and you divide that by the GDP, which is the production that is happening within any given economy, we're sitting, I looked at this a day or so ago, so over 200%. That is a pretty high figure, and could be seen as a significantly on the higher side of the valuation. So that is something definitely worth keeping in mind. There is obviously the prospect of tightening and tapering. Tapering is slowing down or increasing, I should say, the quantitative easing number by what they've mentioned, and tightening is talking about the interest rates going up. So that could be hurtful for some aspects of the market. So you want to definitely keep that in mind on how that might affect different asset classes. We've seen Chinese markets going through some turbulence there due to Evergrande situation. But in general, we do see some positives in emerging markets due to the fact that a lot of the holdings in those areas may be trading at lower valuations compared to maybe the US market. So something to keep in mind. And of course, we mentioned COVID, there was Delta previously, there's Omicron that came up, and there could be other variants, no doubt, that might pop up in the future. So we have to be mindful of how that could affect areas of the economy like traveling, energy, if there's lockdowns, especially ICUs getting slammed and all those things. And also if there is labor shortages, how that might affect the supply chains that, issues that we've been encountering. So there's a lot of different things that we have to be mindful of, but we hope that you are finding this beneficial, inshallah, and we'll turn this back to Shafa.
Thank you so much, Ali Rida. I hope everybody found that beneficial and everyone walks away from today's webinar with something to take away with them. With that, we come to the end, which is the Q&A session. So I do see one question, and someone raised their hand in the participants. If they have a question, it would be a good idea if they posted it in the question box so that we can address that question as well. So the first question that we have is, I believe it would be for Brother Fan. It says, why the ETF's volume is very low? Brother, mute.
Thank you, Sister Shafak, and appreciate that. Yes, we wish that ETF's volumes should be as high as SPY, which is the biggest ETF in terms of volumes. We are going to get there, inshallah. However, what I would like to say is the volume today for SPUS was 56,000 shares, which is not very sparse, I would say, by any chance. Like it has grown. When we started, the volumes used to be 2,000 shares, 3,000 shares. It's now 56,000 shares today. And average for the last year is around 29,000 shares. So it's a process which is like as more and more people are looking at that, it's getting better traded actually. And right now it's the most well traded ETF in all the halal assets, like in all the halal ETFs. It's a trading volume is higher than some of the other halal ETFs out there. SPHK is slightly lower than that, but there are other reasons for that because as a sector, fixed income is a challenging year for fixed income overall. SPRE, it's a new ETF, but it's growing in importance. It has done very well in performance. It's done 35% year to date. And I expect the volume to be really kind of balloon and snowball as we start next year, because as crossing the 1 year anniversary generally brings in the institutional investors in this space. So overall, I think I'm not too much concerned about the volumes for the ETF trading volumes. We have decent volumes for all these ETFs compared to the broader market ETFs, but the better compared to any other halal ETF, and it's gaining more and more as the time goes by.
Thank you so much, Brother Irfan, for that answer. And that kind of brings us to the end. I don't see any more questions. So maybe your presentations were spot on and everyone's questions actually already got answered. So that's the only possibility. With that, I'll give it over to Ali Reda Walji for some closing remarks. And Ali, it's all yours.
Thank you again. Yes, go ahead, Brother Irfan.
There's another question.
Yeah, I see that. How can we watch this? So the presentation is always uploaded right after the webinar on our YouTube channel, on our website. And if you registered for this webinar, it will be emailed to you. So it will be right in your inbox, but you can access it on our YouTube channel as well.
Thank you. Thank you, Shafak. Yes, if you haven't had a chance to look at any of our prior webinars, our media section also on the website has categories of different ones that we've done in the past. So you're welcome to browse and find something that might interest you or speak about a topic that you might be looking to learn more about. With where we're at, a few things I want to point out, based on the discussions I have with clients is, and this is a general principles, a lot of it we discuss with some of our advisors, is that especially Alan, those who know Alan may have heard this in the past, is that investment is a journey, right? It's not a race, it's not a sprint. It's not, how fast did I go in last 6 months? This is a process. And so there are going to be times where certain parts of the portfolio maybe do really well, but some parts are slower. But that doesn't mean that we are, we're not looking. We're watching the fun parts and the parts that are slower, and doing our best to make sure that we're producing the best possible returns for you based on the risk profile, and that it's a journey at the end of the day, right? You're gonna go through different cycles, and we're here to navigate those with you, to help make sense of the markets for you, and to be able to serve and give you the best possible advice. So that's ultimately what we're here for. And we hope that, if you find this to be helpful, inshallah, you can share it with your friends and family. And our doors are always open. If anyone wants to learn more or interact with our team, you're happy to reach out to us. We have probably the easiest phone number to remember, 888 Halal Stocks. Anyone can remember that. And with that, I appreciate your time. And we hope to see you again next year. If we don't meet before then, I hope you all have a good rest of the year. And inshallah, stay safe. And we'll look forward to reconnecting with you here in the new year, inshallah.
Thank you, Ali Reda. Thank you, everyone. Irfan, Kareem, Ali. And just one last comment. I would like to thank all the clients who have submitted the surveys so far. We have sent out some survey. We appreciate your response because it helps us improve in our service. So anyone who has not yet submitted the survey, please go ahead and submit it. And we appreciate the time you give in submitting it. Thank you so much. And Assalamu alaikum, everyone. Have a great rest of the evening.